It's time to debunk all those credit myths out there. You ready? I'm Tanya Rapley. Welcome to a new series from State Farm and Let's Start Today. This is where you'll find the tools, support, and education you need to take control of your finances today and reach your goals for tomorrow. These helpful courses are inspired by an ever-evolving learning lab known as Nextdoor State Farm. And speaking of Nextdoor, I'm here with John, who is a financial coach at Nextdoor State Farm, and Stephanie, who is a State Farm agent.
Yeah, hi.
Thank you guys for joining me.
Thanks for having us.
So we're gonna have a lot of fun talking about credit. And we call this course Credit Myths, wait for it, Discredited.
Oh, nice. I like it, that's good.
So our agenda for this is we'll talk about an overview of credit, just so people get a basic understanding of what it is. Then we'll debunk a few credit myths, and then we'll close out with a few tips for success. Sound good?
Sounds great.
All right, so let's get started. Basics. John, what is credit?
Credit is essentially a measure of your financial responsibility. So if you think about it, sometime during your life, you maybe want to borrow money from somebody for a car, a house, whatever it may be. Well, the person that you're borrowing that money from, that bank, that institution, they want to know, am I going to get my money back, right? And so your credit score is basically a measure of how responsible you are and how you've been handling your money.
Yes, absolutely. And a lot of times when you're at that dealership getting that new car, you love that new car smell that's coming in. Before you drive that puppy off the lot, what they're gonna do is they're gonna take a look at your credit score. And that score is gonna be between 300 and 850. And that's gonna tell them what the likelihood is of them getting their money back. Now, a score over 700 generally says you do a good job. Congratulations, you manage credit well.
Yeah, and you know, credit is important, but I always tell people it's not exactly everything. If it's not perfect, we'll talk about how you can improve it.
Yeah,
it's
absolutely.
one of those things that you can always rebuild it. You can always build it back up. It's not the end of the world.
Yeah. So let's get into a few of these credit myths that we might have heard. So the first one is paying on time helps improve your credit score. Is that true or false?
That is true. Absolutely, that is true. And in fact, the biggest factor that makes up your credit.
Yeah, so 35% of your credit score is simply, do you pay your bills on time? And so that's one of the things that, you definitely want to make sure you're doing. And it's the stuff you should be doing anyway, right?
Yeah, I started singing Destiny's Child, Can You Pay My Bills?
Yeah,
You said that?
There you go.
But it is important to make sure that you are paying on time. As long as you're paying on time, you're doing a great job.
Yep.
Okay.
I got the next question here. So you need to carry a balance to have a good score.
I know it seems like it might be true, but it's false. And I would say probably a pretty common misconception.
Correct.
In fact, the payment history is more important than actually carrying the balance itself. So when I'm sitting down with customers, one of the things that we go over is when we're looking at either rebuilding credit or even just starting from scratch is doing something really manageable from the beginning, like gas or insurance, putting it on that card and then paying it off.
Yeah, you don't have to spend thousands of dollars to build your credit score. A lot of people have that misconception, and understandably so, because most of the time these banks set these minimums and say, hey, if you spend $5,000, you get these points.
Right.
But something as small as a $9.99 subscription service could build your credit.
Yeah, just have it sit on there, use the old trusty auto pay. You're using your card, you're paying it off every month. And to go back to not having to carry a balance, if you are carrying a balance, that's when you're going to have those interest charges.
Oh, yeah.
And, basically being charged money on the purchases you made. So if you can paying it off every month, it's a great idea. But you don't necessarily have to carry a balance to have a good or improve your credit score.
Yeah, automate it, set it, forget it.
Exactly.
I like that. Okay, I have the third one here. You should always cancel credit cards you do not use.
You know, this one confuses a lot of people, but it's actually false.
Right.
So one of the factors that factor into your credit score, we've spoken about paying your credit card on time, but it's also the length of time that you've had credit available to you.
Exactly.
The longer you leave a card open, the longer your credit history. And the longer your credit history, it signals that this person has been responsible, paying their bills on time consistently, and that helps build your credit score.
Yes.
So when you close that card, you start to lose that history.
Exactly.
The other factor that really comes into play here is something called credit utilization ratio, which is really just a mouthful of words.
Yeah, right.
You got me there. That but is how the ratio between how much credit you've used compared to truly how much is available to you.
Yeah.
So just because you have a high credit limit doesn't mean you need to use every single dollar. I know it's tempting.
Probably don't want to,
yes,
right? Yeah.
Right. Do not max out your cards. In fact, the benchmark that you want to be below is 30%.
30%.
Exactly.
The lower the better. Yes.
And not only that, if you have one card or if you have 10 cards, they take all of your cards into account. So that 30% number, that you may have one card that has quite a bit on it, but 3 or 4 cards with no balance.
Yeah.
Your debt to credit ratio or credit utilization ratio might still be below that 30% mark.
Because of all those other cards.
Because they look at it holistically.
Absolutely.
And so you want to keep that overall one below that 30%.
Yep.
Okay, so this next one, applying for a credit card hurts your credit score. Is that true or false?
True.
Unfortunately, it is true, right?
Yes,
Yeah.
yes.
When you apply for a credit card, a loan, a lot of times that's what they call a hard hit on your credit. Or sometimes you may have heard like a ding on your credit. It's only 10% of your overall credit score. And when you do apply for credit, it is on your report for 2 years, and it does fall off after 2 years. Ideally, you do want to have those dings spaced out a few months at a time, and ideally not have a few on your credit report at any given time. But again, life happens, and at the end of the day, it is only 10% of your overall credit score.
And the great thing about those dings, they're on your credit for 2 years, but they only affect your credit score for 1 year.
Correct.
So you'll have that on your credit report, but it's not affecting your score. And I had a woman actually email me this morning, and we had done all this work on improving her credit. And she said, Tanya, I bought a car this weekend, and guess what? My credit score dropped. And it's like, well, that's gonna happen, sweetie, because you took out new debt. It's gonna happen, but continue to pay your bills on time, continue to keep those other utilizations low, and you'll see your credit score rebound in no time.
Exactly.
Absolutely. Yes, I know, but you guys, it is so tempting when you're out, there's a lot of sales going on, you know, doing a little shopping spree. All of a sudden, you know, you're getting up to the cash register with all your great finds, and you're thinking about the damage that's done, right? You're kind of adding it up in your head already. And the lady on the other end of the counter asks you, would you like to save 20% by starting a store card today?
Yes, and it sounds so good. You're like, absolutely. Who doesn't want to save 20%?
It's a big chunk off, 20%.
Right?
Yeah, but
Nothing
what
to
they
sneeze
don't
at.
tell you about that is those cards are usually really high interest rate cards. And so you might save 20%, but they might charge you 25% in interest. So actually you're spending 5% more if you don't pay that balance off immediately.
Right.
Going back to that first one we talked about, paying that balance off immediately.
Yep. And easier said than done, depending on the damage you've done. Are you going to be able to pay it
know.
off in full, right?
That's right. And like you said, even just the look hurts you. If you decide not to do it, them looking at it
just
affects
looking,
your credit score.
And so if they deny you, you're still going to get a
Correct.
ding.
Yep. All right, let's move right along here. So next one, paying cash for everything will improve your credit score.
That is actually false.
It is false, but
Yeah.
I could see how this would be a really common misconception, right?
Yeah.
You're a responsible consumer. You're not having a lot of debt.
Right.
And
Didn't
you're
open any
paying
cards.
in cash,
Yeah,
right?
especially if you're working on your budget, you know, you're trying to create boundaries and so forth, so you're paying for cash.
Right.
They always say cash is king.
Right.
But when it comes to your credit score, it's not.
Yeah, if you don't have a credit card, any sort of payment history, they don't know as far as, you know, institutions, if you're wanting to borrow money from them, if you're going to pay them back or not.
Yeah.
One thing to keep in mind, there is 2 types of credit. So we've been talking about credit cards a lot, and that's what we call revolving credit.
Yeah.
So if you think about it, it's like if you put $100 on your credit card and you pay it off right away, that $100 is immediately available to use again, kind of like a revolving door. The other piece is installment credit. And so for that, think student loans, a car loan, a home loan, certain number of months, certain number of installments, and then it's paid off, right?
Yeah.
So we've been throwing out a lot of percentages. Another one is 10% of your credit score is also what we call the credit mix.
Yeah.
Do you have both of those types of credit, revolving and installment? If you only have one and not the other, it's not the end of the world. Again, only 10%. But be aware of those 2 different types.
Yeah, because banks want to see you properly manage different types of credits. Like you can pay your credit card, but can you pay a mortgage?
Exactly.
And when you can pay both, it's like, okay, they're responsible and can handle different types of credit available to them.
Okay, your income has an impact on your credit score.
That's false.
Yep.
A lot of things have an
false.
impact on your credit score, but not your income. Thankfully,
Thankfully.
what you make, who you are, your gender, your religion, those factors do not affect your credit score.
Yes,
Exactly.
absolutely. And this really levels the playing field a bit too, because even if you may have a low wage, you can still keep a really high credit score by paying on time, right?
Yes.
That's the biggest one.
So I think that that's really important to know, and a good hope for a lot of people who maybe don't make $1 million a year, they can still have a really great credit score. Now, on the other hand, someone who does make millions of dollars could have a really poor credit score.
They could. And there's not a direct correlation. Like, just because you make a lot of money doesn't mean you have a good credit score. Just because you don't make a lot of money doesn't mean that you have to have a low credit score.
Yeah, and I really like this one too, because I think the income question is a lot of the confusion out there, just because it makes sense to assume that how much money you make might affect your credit score. But it does not.
Yeah, it can affect a lot of things, but not your credit score, thankfully.
Yeah, it should be said that applying for certain types of installment loans, they will look at your income in conjunction or in relation to your credit score as well too. So while it may be an important factor in some things, it just doesn't impact the score itself.
Absolutely. That's a great point. So the next one is you can rebuild a poor credit history.
Yes!
Thankfully, you can.
For sure, you can do it, yes.
It's one of those things, it's tied to your social security number. For better or worse, it's not going anywhere, right? So you can always rebuild. If you're in a place right now where you're kind of confused, you're tuning in because you want to know what are some of the things you can do.
Yeah.
We've mentioned a lot of them already, and we're just going to keep hitting them home, right? 35% of your score, just pay your bills on time. And I do want to point out that if you've got a credit card due on the 10th of the month, and you forget you're out of town, you pay it on the 13th, yeah, you may get a late charge, but it's not going to hurt your credit report. You have to be a full 30 days behind before it's actually going to show up as a negative mark on your credit report. Obviously not something that you want to flirt with and try to avoid that, but it's not the end of the world if you're a couple days late.
Yeah, definitely. For someone who would want to rebuild their credit score, it's just like, watching a course like this, that's a step in the right direction. And understanding how credit works so that you can actually begin to make credit work for you. So by finishing this course, you're one step closer to rebuilding your credit score.
So let's say if you have a bankruptcy, for example, that will stay on your credit report for 10 years, and that'll eventually fall off, but it's not the end of the world.
Yeah, it's not a scarlet letter. You are not barred from the financial services system just because you had that bankruptcy.
Yeah, and the key here is how are you managing everything else to rebound from that?
Yeah, and you want to identify the factors that contributed to it so that you don't get back in trouble again.
Exactly.
I like to say that credit, it's almost like elastic. It's like a rubber band. You can stretch it out, you can overuse it, but it comes right back. Stretch it out, comes right back. And if someone is watching this course and they're saying, you know what, I want to improve my credit score, which will probably happen as a result of watching this, hopefully.
Yeah.
But you start to understand how credit works for you. And so even if you were to go apply for a loan for a car, or if you went and purchased a home and your credit score dropped, you know what you need to do to rebuild it. And you have the tools necessary to rebuild it. And as long as you have those tools and those good habits, you're going to rebuild your credit score.
It's funny that you mentioned calling, because a lot of times what I'll do with customers when I sit down with them is when we get on the topic of their credit score and credit reporting, we'll call together to the lending institution, and even if they are a couple days late, and just see if there's anything that can be done. But it really takes that proactive action to just make the call and talk to them. They're really open to talking to you too, because they want you to pay.
Exactly.
I'm happy you brought that up, Stephanie, because I think that people don't understand there are people on the other side of those lines who are understanding and they are compassionate. And a lot of times they want to see you do well too. And so just communicating your situation to them, if you know that you're going to be late, or if you know you're experiencing an issue or you have questions, they often are more than happy to help you. And if you get someone who isn't, call right back. You'll probably get somebody else.
Exactly.
You'll get somebody else and they'll probably help you.
Yeah.
All right, so let's take this one. Your credit can prevent you from getting a job.
Yeah, unfortunately, that's true.
That is true. Yeah.
It's one of those things where, when you're applying for work, your employer may look into your credit because they are, looking at the field. There's going to be a whole bunch of different people they're looking at, and depending on what type of role that you've applied for or they're hiring for, it may make sense that your credit would affect that.
And it seems unfair because it can seem like a catch-22. My credit score dropped because I didn't have a job to pay my bills, and now I can't get a job because I don't have a good credit score. It does seem like a catch-22.
It's like the entry-level position with 3 to 5 years experience required.
Yeah, it is, but The reality is they do use credit scores and credit reports to get a basic understanding of how responsible you are. And it might signal to them that you're not as responsible as they hope you'd be for that job.
But the bright side, like we've been saying, there's always room to improve, always room to improve it
Absolutely.
and make that credit score go up.
And with tools and action, you can do it.
Yeah, and I want to bring up too that if you are a great candidate, sometimes one of the things that they will look for is a letter of explanation of maybe what has happened in the past, and that may be a solution to overcoming an obstacle like that, especially if you're qualified for every other area. That's the only thing. So just know that that may not be the end-all be-all. There may be some ways around that. But again, it's that open communication. You have to make that call. You have to sit down and say, hey, here's the deal. I haven't been as responsible before, but this is what I'm looking to do and change my life and really ultimately improve.
And Stephanie, you're right. That's something that I did with one of my first jobs out of college, because I went to college and lost my mind and racked up all this credit card debt, got out of college, and really I had to write that letter. Luckily, it was a smaller company and they were more understanding and they gave me a chance. But like we said, people are people. Communicate with others. You know, what was going on in your life? You know, did you have a medical emergency? Was there job loss or something of that nature? And don't count yourself out. Just because they give you that, we're going to pull your credit report, slipping you have to sign off for it, don't count yourself out.
Well, I'm glad you guys bring that up, because I mean, something that you can take action on today is go to annualcreditreport.com. It's the only government-sponsored website. You can get your credit report for free. We recommend you just pull one of them, because each bureau has to offer you your report for free in a 12-month period. So, long story short, every 4 months you can pull from a new one and cycle through them. So, what's on your credit report is typically there for about 7 to 10 years. So if you have had some mistakes in the past, maybe missed some payments, the bright side of that too is that the farther those things are in the past, the less likely the employer's maybe going to care about it, right? So if you had some bad mistakes 2-3 years ago, but you've shown excellent payment history the past 2 or 3 years, may still help you out.
Yeah, so pull that report, know before you go, know before you apply.
You got it. Credit repair companies can erase bad marks on your credit report.
You know, this one's floating around a lot out there, but it's actually false. And it's understandable why people would think that, because it's floating around out there.
A lot of companies say they can remove those bad marks.
Yeah, and they sound really convincing.
Right, they do. The radio ads like always have this like bip-boppity music. And they're like, you have problems, we'll solve them.
All of them. Doesn't matter how big they are, we'll solve them. And is it legal, you know?
Yeah, well, I mean, at the end of the day, all they're doing is saying, we'll go into your credit report and correct things that are actually incorrect, and you can pay us for that. But that's something you can do on your own for free. Because if there's something on your credit report that's not correct, you can dispute it. They have to look into it and get back to you within 30 days.
And think about all the other ways that you could use that money.
Exactly.
You know, instead of paying someone else, you know, you could use that money to build your savings account or do something you care about or go on a shopping spree.
Yeah, pay off that credit card, right?
Pay off that, pay off that credit card, John.
We'll start there.
Yeah, there you go.
So absolutely, yes. And I think that it's important people understand that they have the power to improve their own credit. It doesn't rest in the hands of some company that has this expertise that you don't have. Okay, so for the next one, it is, your credit report always includes your credit score. Is that true or false? That's a tricky question.
That is a tricky question. But it's false.
Yeah, they're actually two separate things, to be honest. I mean, we talk about credit in this holistic term, which it is, but when you get down to credit score and credit report, the way I look at it is your credit score, that's that number that Stephanie had mentioned, 300 to 850. The higher the better. That's like your final GPA in school. Where your credit report, that's like your transcript of all the classes you ever took. So basically everything that's on that report is what dictates the score. And typically they are separate.
Yeah, everything that factors into that. And just because you pull your credit report, it doesn't mean that they'll provide you with your credit score.
Exactly.
It's important to know that. And sometimes just because you access your credit score doesn't mean they'll give you your credit report.
Yeah, and there are a lot of third-party sites and a lot of credit cards out there nowadays will offer your score for free. So that may be something to check out. Yeah,
so I think a good tip here is for someone to look at not only their credit report, but their score, or if you have your credit score, make sure you're looking at the items on your credit report.
Right, and there, again, are 3 main things that you should be looking for. Revolving credit, installment credit, and then any judgments, liens, collections against you, and then who's been looking at it? Who's checking?
Those inquiries, Have you ever looked at your inquiries and like, who is this company? Because some companies, it's still not a hard pull, but they can still take a soft peek to determine if they want to send you a pre-approval offer. And sometimes I'm like, who's looking at my credit?
Well, that's what I say, like a high-level blanket term of all of those hits that you don't recognize the names, probably junk mail.
Right.
Yeah, but those aren't negatively affecting your credit score.
They're just looking at some soft indicators to determine, do we think she'll love this credit card
Exactly.
when it comes in the mail?
Let's see if we can entice her.
Yes, absolutely.
All right, so how about this one? All credit reports are the same for each major bureau.
That is actually false.
That is false.
Yeah.
Yes.
You would think that it's true because it's like, hey, credit, you know, I have the same accounts, but all bureaus and all companies aren't required to report to each bureau. They're just not required. It's kind of voluntary. So they might say, hey, we have a great relationship with this company. We'll go ahead and report to them, but not to the others. Yeah,
so at the end of the day, you know, what's on your credit report, there's 3 major credit bureaus. And what's on those is essentially what gets reported to them. Like they don't go out trying to seek the information of the credit cards or the home loans or whatever that is.
Knocking on doors, hey,
exactly.
What do they do?
They just sit back and get what's reported to them. So some companies out there, they may report to only one and not the other 2, or 2 and not the other one. So although the information is going to be very, very close to identical, there may be a couple of things that are a little different.
Yeah, and that's why they say calculate your mid score, which is the average of all 3 scores from their bureaus, because all of them could have different information.
The only government-sponsored website is annualcreditreport.com, where you can go pull your credit report for free, and no, it does not hurt your credit to do this. And like we mentioned, there are 3 major bureaus. We typically say just pull one, doesn't matter which one. Take a look at it, make sure everything's correct and accurate. If it's not, you can go ahead and dispute it. And then every 4 months, you can pull from the one that you haven't pulled from, and that way for free, 3 times a year, you can check your credit to make sure it's all correct and accurate.
Absolutely, and make sure that you're saving your credit report for your own records. Make sure you save it for your reference.
Yeah, that's a good point, Tanya, because when you do check it, it pulls it up. Once you close the window, it's gone.
Absolutely. Okay. All right, last one here. Credit reports merge on marriage and separate on divorce.
No, false, thank God.
Yes, absolutely. It is false. I like to say there's really 3 things that you bring to your marriage. You do bring love, which is very important, of course. You bring home a paycheck a lot of times. And the third is you do come with your individual credit score. And regardless of what your credit score is, it's really not impacting that other person unless you hold joint accounts or joint responsibilities together. Now, you know, unfortunately, if the day comes where you do have a divorce or get a divorce, you really do have to be mindful of if you made your spouse a joint account owner, or if they are an authorized user on one of your cards. So that really gives them access with no responsibility, which is ultimately affecting your individual score.
Yeah, and you know, I think it's important for people to understand that your romantic relationship is also a financial decision. So how they manage their money can affect you. And even though your credit reports and your credit scores aren't necessarily merged, if they're not paying their bills, they might not contribute to the household bills. So it is something to, you know, ask that question once you realize that, hey, I really like this person.
Have that money talk, right?
Yeah, have that money talk with them, because it is important. How they manage their bills is important, even if you're not till death do us part when it comes to your credit score and your report.
So Tanya, for all my single friends out there, for first dates, they should ask him to come with
first date. I mean, depends on the person. You know, some people might be like, oh my God, she's really on it. And some people like, they're crazy.
Can you please bring your credit score for me?
But it is an important conversation to have, and those financial conversations are important in general in relationships. But the great thing is that if you do happen to get in a relationship with someone who's not as financially savvy, and you decide, you know what, this doesn't work out on any level, that you're no longer going to be affected by their credit history if you did not co-sign or enter a joint account with them.
Absolutely. Yes, absolutely. And on the other hand of that, if you enter into a relationship with somebody, use it as a good teaching moment to help them and to share your knowledge of how you have established this really good credit and to where you can build it up together.
Okay, so guys, I think we covered a lot of ground here. Consider these myths debunked.
For sure.
Okay, so let's have a look at what we've learned. Make sure you dig in and explore all of our tools, support, and education. And don't forget to check out all of our courses. See you soon.